Okay, folks, let's go ahead and get started. So as a reminder, this is week 7 of this 8-week seminar. So next week will be the final seminar. We'll do a recap and we'll talk about the path going forward. Okay, so tonight is about financial advisors. I know probably some of you may have one. It probably sounds like I hate them. Okay, I don't hate anybody. What I would tell you is, as we go through this, and I'll remind you of it, the system is built for the system and their advisors. So if you're going to find a way to keep more of your money, you need to take the time to understand how this works and how people make money and how you can reduce the amount of money that's taken out of your portfolio. Because at the end of the day, you're the one who's going to have to live with those results. As I talk about financial advisors, I started with one, right? Why? Because I didn't know any better. I didn't understand what I was doing. I didn't understand the difference between a fee-based financial advisor and a fee only. So by the end of today, I sincerely hope everyone in here knows exactly what the difference is between those two types of advisors. One should be avoided at all costs. The other one could be considered when you need help. Because a reminder, I'm the guy who says you can do it yourself, right? And I think most of you can. But for those of you who think you need a little bit of help, and sometimes we need help, there are places to go and people to see. As I talk about this issue too, thinking about your relatives, senior relatives, people that are older that maybe do need help. Because, grandma, grandpa, somebody who's having someone else manage their money, how much is that costing them? So be thinking about that issue as we go through the issues today. Let's get started. So why you might need help, right? So you need help with investment policy, that asset allocation issue. So we talked about that for about 3 good weeks. And some of you get it. And some of you might think, Finley, that's just a little complicated. And you know what? Okay. So the right type of advisor could help you with investment policy. Transferring funds. So that's a big deal, right? You have money in crappy funds at some location, and in your mind, you're trying to get it over, but you don't know how the whole process works. Well, a financial advisor can help you with that. Because sometimes we need a nudge, right? Sometimes we need somebody to shove us, but we need to get that ball rolling. You just don't think you can do it. Now, that's the answer I really don't like to hear. I like you to believe that you can do it, but for some people, they just aren't quite ready to make that commitment. So go through the process of maybe getting an advisor. And by the way, all these decisions, even when you choose an advisor, you're the one making that decision. You're the one living with the consequences. So if you choose the wrong advisor and you get screwed, it's your fault, just like it was my fault. So keep that in mind. You have problems harnessing your emotions. That's a really good reason to have a financial advisor. So what does that mean? Markets are tanking and you are apt to sell everything because your emotions are getting the best of you. You watch too much television, you hear people say, get out, you basically have a hard time controlling your emotions. And if that's the case, a good advisor can make the world of difference. They can stop you from hurting yourself. So financial planning, some people need this. So I'm talking about insurance strategies, right? Basically identifying how to get the right kind of insurance, how to avoid the wrong kind of insurance policy. Retirement strategies, Social Security strategies, the kind of strategies that could be worth a whole lot of money. These are huge decisions. And so a good advisor at a reasonable cost could certainly be well worth the money for something like that. Tax management or reduction strategies and how to withdraw money out of retirement accounts. Big deals. Big deals. So again, a good advisor at a reasonable cost could be worth every dollar you pay them. Estate planning, end of life planning. It's another reason why you might decide to have an advisor to help you through that process. So where are we now, right? What is the current situation, the current environment? Well, as I said, the system is built for the system. It's not built for you and me. It never has been. Now, thanks to John Bogle, who started the first index fund, it's a lot more friendly to us if we know what we're doing. But at the end of the day, the system is there to make money off of you, not for you. Okay, all the commercials, all the feel-good messages, it's just a bunch of crap. It's marketing. It's not real. Their goal is to make as much money off of you as they can. So just come at it and realize it. That's the way the system's built. That doesn't mean you have to fall for that approach. Their salaries are based on how much money's pulled in. In the vast majority of cases, it's not how well you've done. That's not how they make their most money. It's how much money they can pull in to manage, to play with in many cases. So that's what it's really about, is how much money can they corral so they're in control of your money as they take a piece of it year after year after year. So you want to avoid the vast majority of financial helpers. The vast majority, when I say like 90-some%, probably in the 98th percentile, maybe 99. Now again, am I saying these people are evil? Nope, they're not evil. Most of them are average people trying to make a buck. They're not doing anything illegal in the vast majority of cases. They're just basically taking more money from you than they should. That's the bottom line. So which type of advisor should you have? A fee-based financial advisor or a fee only? So before we go into that, I think it's worth looking at an illustration. I'll tell you what, we'll pause on the illustration. I want to talk about a few more things before we get there. So they get paid by other people behind the scenes, right? The fee-based advisor, which you want to avoid, by the way, you want to avoid fee-based advisors because they're getting paid by other parties to push products and services on you. Conflicts of interest, right? They're always there. And they're big conflicts of interest, not small. If somebody's paying me a whole lot of money over here and you're paying me, not so much, I'm working for them. I'm not working for you. So when they get a lot of money and it's getting paid by someone else, you really start to realize who they're working for. No matter what their marketing messages say, no matter how many commercials tell you they care about you, they're not working for you. They're working for the dollar and whoever's paying them the most. So it should be avoided at every turn, every turn. And again, it's not that hard. Once you start to learn exactly what a fee-based advisor is and how they make money, you are able to identify that when looking for assistance. So almost all insurance agents, when I say almost all, like 99.9%. So insurance agent, fee-based, you want to avoid them. You never want to invest using insurance agents, period. Insurance products, as we've talked about, one of the worst possible ways to invest your money. Why? Fees. Fees are dramatically higher. You can pay 2, 3, 4% a year, maybe 5% a year in fees through insurance products, annuities, whole life, etc. Almost all investment brokers, they're not working for you. They don't have to do what's best for you. They're doing what's best for them. And generally what's best for them is trading. They need you to trade a lot because they're going to make more money. Whether you make money doing it or not, it doesn't matter. As long as you're trading, they're making their money. Most advisors who are sitting in banks and credit unions, they should be avoided. They're fee-based. So years ago, the banks, the credit unions, they decided, you know what? There's a lot of money in this stuff. We want to get in it. We want to get our piece. So they bring in these fee-based advisors into their credit unions and banks. Why? Because there's a certain degree of trust that many of us have with our local bank or a local credit union. And that advisor knows that. So they're happy to be sitting inside that facility because you have this idea that, okay, they're looking out for me. It's not the case, but you can have that impression. It's easy to start to feel like, yeah, no, they're not. Most of the time, credit unions especially, they're selling annuities. So their advisors are there to push products that make them money. Credit union gets a kickback. Everybody's making money off of your money. Basically, most other financial advisors, most of them out there, again, 98, 99% are fee-based. So life insurance agents, cash value pays really well. 100% commissions in the first year. Think about that. So in the first year that you pony up money for a whole life policy, and you're ponying up whatever, $200 a month, every dollar that is in most cases going to the commission of the agent. So after 1 year, you're worth nothing. And you have to actually pony up a lot of money over a long period of time to start catching up. And they call that an investment. Annuities, they pay really well. Anywhere between 6 and 10% commissions. Give them a chunk of money, and we have some examples. They're going to take a big chunk. And they're going to tell you things like, oh, you don't pay me. Dude, you're paying. Those fees are created inside the accounts. You just don't get a bill. Because again, the industry learned long ago, don't send people bills, they don't like bills. So create it inside this product, and guess what? People will feel good about it. And many people have fallen for that, including myself. I owned a whole life policy once upon a time. Sounded great. I thought it was a great deal. Well, yeah, because a life insurance agent was educating me. And I didn't know any better. And I got took, but that was my fault. Because of my lack of understanding, I'm the one who made a decision that cost me a lot of money. Commissions get paid up front, and then trailer fees last forever. So what's a trailer fee? Well, basically 1% of a product. So that annuity, let's say the agent earns 8% commission on a chunk of money you give them. They're also going to earn about 1% a year on that annuity for as long as you own it. Easiest money man's going to make. Think about it. He gets 1% for doing absolutely nothing. And if he can put more and more people in annuities, he can basically go play on the golf course because he's getting money every year, that 1% trailer fee off that annuity. Basically, the bottom line, just don't invest in insurance products. But again, that also means don't hang out with insurance agents. Don't do it because they are good at selling. If they were not good at it, they'd be doing something else. Whole life example. Right? Somebody has a policy, I call them a victim, of $8,000 a year. And so in that cash value policy, that insurance agent's going to earn $8,000 in that first year. It's going in his pocket. And they call that an investment. So it's an investment slash insurance product. It's crap. But again, the industry creates products to make money for the industry. It can take a decade for that to catch up to zero. What does that mean? So you're paying $8,000 a year. After 10 years, you put in $80,000. Your investment would be worth about $80,000 after 10 years. Meaning you made no money after 1 decade. And again, these policies are sold all the time. Why? Because people lack an understanding of how they work, and the insurance agents are very good at selling them. They're very good at marketing them. They're very good at convincing you that this is exactly what you need. Put that money in a basic Vanguard total stock market index fund, earning maybe 8% a year. You've got 129,000 after 10 years instead of 80. Because you actually make money in a low-cost index fund because the fees are so low. So again, you and I, we have options today, thanks to a guy by the name of John Bogle, started that first index fund, created a product that served you, the investor, over the industry. So we should be thankful, but we also have to take advantage of the opportunity. So Annuity Example. Individual retires with $900,000. So they've been saving all their life, maybe they have it in a 401k, and now it's like, okay, I'm scared of the stock market, so I'm going to play it safe. And they're going to put it into an annuity. Well, that's what the recommended option is by the agent. Why? Because the agent's going to earn a big fat commission. Earns an 8% commission, $72,000. 1% yearly trailer fee, $9,000. Think about that. Now, this is when one of you might be thinking, man, I should be an insurance agent. Yeah, yeah. There's good money in that. There's no doubt about that. There is. And so the average person would see that $72,000 and think, oh, well, I'm not paying. Dude, you're paying it. Who do you think is paying that? Do you think the insurance company is paying? No, they're making money off the product. Do you think the agent? No, they're earning that money. It's coming out of your pocket over that 8 years. Basically, the bigger the commission, the more the years that it's locked up, and you can't get it out with very big surrender penalties because they lock it up to pay that commission. That's how they work. And they work very well for them. They win, you lose. And again, for some of you, you might think, well, why doesn't anybody tell me that? Well, who's going to tell you? Who's going to tell you that? The insurance companies? No. They're going to tell you they have great products. So that's why we have to find independent sources who are going to educate us on stuff like this. And once we do, we start to see the truth. The truth is there. So those stockbrokers, honestly, I think, and you can tell me if I'm wrong, I think most of you realize stockbrokers are kind of like used car salesmen, right? Probably. Oh, used car salesman?
No, I agree.
Oh, okay. I'm not here to knock car salesmen, by the way. We have a certain impression of a car salesman, right? That's what I'm implying. Actually, I value car salesmen over them, to be honest with you. But they're in that category. They really are. And I think many people hopefully see that, but they don't necessarily see the local fee-based advisor / life insurance agent in a similar way. I'm here to tell you they are similar. They're salespeople selling a product, whether it's a car or some kind of crappy annuity. They work between you and your investments. Right? They make money when you trade. The more you trade, the more they make. They subtract from your bottom line. They don't add to it, they subtract. Again, stockbroker's going to tell you, no, I don't. No, you don't, dude. You don't know. He is going to lose you money over time. You don't need them, and you certainly cannot afford them. And gentlemen, I'm sorry if I keep saying he. There's plenty of women screwing people too, okay? But more times than not, I tend to see the he. Credit unions and banks, they want their cut. They sell those high-cost annuities in many, many cases. Why? Because people are getting kickbacks off them. They use name recognition, I just talked about. You have a good trust with their bank, so they bring the advisor into that bank, and hopefully you're going to use that advisor. That's the idea, and it works in many cases. So you should just run away from those wealth-depleting helpers. They deplete your wealth over time. So other advisors, some of the local companies, there's not much of a difference. They want you to think there's this huge, there's not much of a difference. Whether it's Edward Jones, Ameriprise, Transamerica, and there are many. They're all selling a product. They're all trying to convince you that, they're there to make your money grow. And they're there to pull as much in the way of fees as they can, period. That's the truth, kind of hidden behind all the marketing messages. So the company, the salespeople, right, they have to get paid. So there's a lot of people, by the way, feeding off of your account. So let's say you use the local Ameriprise agent. And guess what? Ameriprise is getting a little bit of their cut because it falls under Ameriprise. What about the secretary for the Ameriprise? Oh, yeah, she's got to get paid. Everybody's got to get paid, and they're all getting paid out of your portfolio. Fees reduce the returns dramatically. It is that simple. People like to say, oh, it's not. Yes, it's that simple. Lower your fees, increase your returns. High fees, decrease your returns. Yes, sir.
I have a situation where my wife's transfer 401k about 8 mutual funds in there, and one of them has a Vanguard fund, and like one of those companies that you talked about there, and that she dealing with St. Paul's. So I was thinking about eliminating all those, switching everything over to Vanguard. So if I continue to still use that company versus going directly to Vanguard, they're still going to charge an up cost.
So the answer is maybe, right? Is it outside of a retirement account? Is it, for instance, an IRA, a Roth IRA? Okay, so it's in a rollover IRA then. And again, do they charge an advisor fee? Is it just the fee for the mutual fund? So I'll have an illustration that's going to show the different ways in which they make money. What I would tell you is I'd get the hell out of there as fast as I could. I would transfer the funds over. You can transfer them in kind, meaning the funds owned there would be owned at Vanguard, and then you can decide whether or not to once they're there. And you may decide to keep that Vanguard fund while it's there based on what it owns and the cost.
But you would switch it over everything else except for.
Oh yeah, I'd move it all. I'd move it all, and then I would decide at the Vanguard brokerage account whether or not I'm going to keep it. Because you're going to be able to see the fees clearly, and you know it's just that fee. It's nothing else.
The one fund that she was in, actually got on the Vanguard, and I took it close to the investors.
Okay.
So that's what I was kind of concerned about.
Here's good news. Good news. Every fund that I recommend, funds that you should consider investing in, not one of them are closed. Not one. So I would not worry about any of the closed mutual funds, even at Vanguard. For everyone that's closed, there's a better low-cost option available at Vanguard in index funds. Okay? That is possible. So there's, and that's one, and that certainly has happened a lot recently. The other possibility is some managed funds do close because they don't want more money. So at Vanguard, they'll close a fund because it gets harder and harder to manage a larger amount of money. So they'll close it to keep that at a manageable level. So that also can happen over time. Now, that doesn't always happen in many other places, right? It's like, no, just give us money. Oh, just somehow just give it, right? Yeah. So small amounts per year equal big amounts over time. So cost always matters, right? Somebody starting with $50,000, what does that look like after 40 years, right? 50,000 after 40 years, and 5%, 4%, 3, 2, 1, and 0.04, which happens to be the cost of the Vanguard Total Stock Market Index Fund. Well, a lot of times, and I come across people, they'll have an account maybe like that or maybe like that, and they'll say to me, look how much money I've made. Well, what could you have made? See, they forget that piece of the equation. Because as those fees go down, that return can go up in some pretty big ways over time. The same return, the same time period, the same amount of money, the difference is fees. Squeezing out the fees will increase your returns over time. You've heard me say it. I'm going to keep saying it. I'm going to say it until I'm blue in the face. John Bogle said it for 40 plus years. Once we fully acknowledge that, we start to figure out ways to reduce those fees. So you end up with most of the return because you're the one taking the risk. So fee-based financial advisors recap, they get paid in multiple ways. Illustration is going to show that. By multiple parties. Have all kinds of conflicts of interest. It stops them from doing what's best for you. The training is in sales. That's their training. They're expert on sales. Just like car salesman, sales. The car salesman is not an expert on that car he's selling. He knows how to sell that car. And all they really have to do is give you a suitability standard, meaning, well, it's good enough. It's good enough for you. It doesn't have to be the best thing for you. It's just good enough. That's what suitability has. If somebody has a suitability standard, you should run away from them as fast as possible. It costs you a lot of money. End of the day, they cost you a great deal of money. Now let's see the illustration. Where's my illustration? I don't even see my... Where did you go? Say again. The window on my left. Yes, it is. Okay. So what you see here, take some time to kind of take it in. You see money, which is the client, coming in, and then how money is being basically taken from you to manage it. Because at the end of the day, your money is going over here to the investments. So how does it get to the investments? So the fee-based advisor is down here. The fee-only advisor, which we'll talk about in the next segment, is up there. So in that first segment, well, you're going to pay a fee for an advisor, bottom line. So those fees could be transparent. They could be right up front. That could be done by fee-only advisor. Could also be done by fee-based advisor. But then things start to get interesting because the fee-based advisor is also making money over here. So they have multiple streams of income. And if you've ever studied wealth, that's a plus. You become wealthy with multiple streams of income. And so, yes, again, this can be a lucrative business, which is why most people are fee-based advisors. There's a lot more money in this than there is in that. So the fee-only advisor isn't getting any money beyond that initial fee. And it's transparent, and you see it, and there it is. Here, you almost never see these. But they're there. And bonus, well, how much money can they pull in? Trailer fee, just make it every year for doing nothing. Loads, right, that commission that goes to the salesman as you buy a mutual fund, and then commissions from transactions that a stockbroker may have. So by understanding how it works, understanding how people make money, your job is to find ways to reduce all those people feeding off of your account. Any questions on this illustration? If you like this illustration or the PowerPoint, feel free to send me an email and I'll send them to you. So when I talk about how the industry markets, notice how effective this commercial appears. So here's the short version. Give us your money so we can screw you. A little bit of humor with this video. Sadly, there's a lot of truth to it.
I just came back from meeting with Charles, our new financial advisor.
Good. What did you tell him?
I said we had just cashed in our 401ks and have $1 million for our retirement.
Good. What did he say?
He said he will manage that for us.
What will he do?
He will invest the money and tell us how much we can spend each year.
How will he manage the money?
He will invest it in good mutual funds, really good hedge funds and ETFs and maybe structured products.
Which are the good mutual funds?
They are the ones that buy good stocks or bonds and don't buy bad ones.
Isn't it hard to do?
Yes, but Charles knows who can do it.
Do the mutual funds charge for doing this?
Yes. From 1 to 2% of our money every year.
Doesn't that mean that after 20 years they will have lots of our money?
Yes. But there will be more money because they will buy the good stocks and bonds.
Okay. Will Charles buy index mutual funds?
No. Because they buy both the good stocks and bonds and the bad ones too.
Okay. What are the ETFs?
They are sort of like mutual funds, but Charles can trade them every minute.
Do they buy good stocks and bonds too?
No. They allow Charles to bet on all kinds of things. He can bet on the good things and bet against the bad things.
Do the ETFs take some of our money too?
Yes. And we have to pay the Wall Street traders when Charles makes his bets. But he will only make good bets.
Okay. What are hedge funds?
They buy good stocks or bonds and bet against bad ones. That way they can make money when markets go up and when markets go down.
Isn't it hard?
Yes. But Charles knows the smart hedge fund people.
Do the smart hedge fund people take some of our money?
Yes. They take 2% every year and 20% of anything we win.
What do they take when we lose?
They take 2% of what is left every year.
Do they give back 20% of what we lose?
No.
What do they do if we lose a lot of money?
They close the fund and open a new one.
Okay. What is a structured product?
It goes up when the stock market goes up, but doesn't go down when the market goes down.
Where does Charles find these?
On Wall Street.
Where on Wall Street?
He used to get them from the Lehman Brothers, but they went bankrupt. But he knows other brothers on Wall Street.
How do the Wall Street other brothers make the structured products?
They have financial engineers make them out of derivatives.
Do you know what this means?
No.
Does Charles know what this means?
I don't think so.
Can the Wall Street other brothers go bankrupt too?
Probably not.
Why not?
Because that have better friends in Washington.
Okay. Do the Wall Street other brothers make lots of money?
Yes.
Will some of this be our money?
Probably.
Okay. Does Charles get money from the mutual funds, the ETFs, the hedge funds and Wall Street?
Yes.
Does Charles charge us too?
Of course.
What else does Charles do for us?
He tells us how much to spend each year.
Good. How much of our $1 million can we spend this year?
40,000.
Why?
Because that is 4% of our $1 million.
Okay. How about next year?
$40,000 plus a raise for inflation.
Okay. How about the next year?
$40,000 plus another raise for inflation.
And after that?
$40,000 plus raises for inflation.
But what if our investments lose money?
We still spend $40,000 plus raises for inflation.
Why?
Charles says that after markets go down they usually go back up.
And if our investments make lots of money?
We still spend $40,000 plus raises for inflation.
Why?
Charles says that after markets go up they sometimes go back down.
But if we keep spending 40,000 plus raises for inflation, couldn't we run out of money?
Charles says scientific studies show we are likely to have plenty left for the kids after we are gone.
But we don't like our kids.
Charles says he knows some good charities.
Okay. But if we can only spend 40,000 each year plus raises for inflation, so we can leave lots of money to our kids or charity, what about our plans to take a cruise to Mexico?
Charles says we should take the ferry from San Francisco to Sausalito instead.
I suppose. Can we meet with Charles next month?
No. He is taking his whole family on a long cruise to Mexico.
Oh.
Sadly, there's more truth to that than we can admit. Okay, fee-only financial advisors. This is the kind of financial advisor you would consider when you need help. So you pay them an agreed amount of money, right? You agree to it, you talk about it, that's what you're going to pay. You speak to them, and it's transparent. They reduce the conflict of interest. It doesn't necessarily eliminate every conflict of interest, but it eliminates most of them. So you're getting somebody who's actually working for you instead of someone else. And again, they can help you with investment policy, putting together asset allocation, or they can help with financial planning. What I would tell you is financial planning, that's where an advisor is going to make you the most money. Investment policy, putting together asset allocation is not that hard. In other words, somebody can help you do that. You can do that with this class. You can do that with an advisor, and it's done. The harder part is deciding when to pull Social Security and what kind of insurance policies to have and how to reduce your taxes and all these issues that come into play as we age. Bottom line, it's going to come down to you. The decision you make is going to decide how much money you end up in the long run. So some criteria. When you're looking at a fee-only advisor, what will you be looking for? Because, by the way, there are plenty of fee-only financial advisors. I wouldn't go near them. So are they a fiduciary? It's real simple. Do you work for me? If you ask that question and they stumble, get the hell out there. You know, if they answer like, well, okay, leave. That means no. Just get the hell out of there. If they can't answer simply, yes, I'm a fiduciary for you and you only. If they say that, then you proceed on. What kind of assistance do they offer, right? What do they do? And again, they should be able to explain that in simple terms. How do they make money? Again, if your advisor cannot explain this in simple terms, get rid of the advisor. It's not that complicated. If they can't tell you in a transparent way exactly how they make money, you don't need them. And how much do they charge? And charge for what? Are they doing a financial plan? Are they charging by the hour? Are they charging you based on money under management? Exactly how are they making money per ways in which they provide services? So what is their philosophy, right, on investing? So it should be passive. Real simple, passive. Owning low-cost index funds. You could own low-cost ETFs, and then you buy and you hold. You don't buy and sell. You don't time the market. You don't try to get in certain sectors and out of others. So basically, you want a fee-only financial advisor who doesn't have a large ego, who doesn't think somehow they know what's going to happen next. They simply help you allocate appropriately and then help you with financial planning. At asset allocation, again, putting together a portfolio. If they can't do that, you probably want a different advisor, because that is not that hard. Most advisors should be able to put that together in a low-cost way, or it's going to cost you a minimal amount of money. A minimal amount. So that approach, right, and the cost, what is that going to cost? In other words, you'd ask an advisor, so what is the portfolio cost generally going to be for somebody like me? They should be able to tell you that. So for example, right, my portfolio cost is 0.07. For most people, you should be able to get your portfolio cost down below or at least at 0.10. In most cases, that shouldn't be very hard. Now, can that vary? Yeah, because some people have crappy 401ks. And you have a 401k and you don't have any low-cost options. A good advisor would basically try to help you make the best of the crappy choices you have. Yes, ma'am. Well, I'm still trying to figure out so explain a little bit more and what you're asking. Correct. Okay, so you do not want overlapping investments within a portfolio. A good advisor would tell you that. They would say, okay, you've got this twice. You don't need this twice. Diversification is owning these different asset classes in amounts without duplication. So a good advisor would be able to break down a portfolio, break down a mutual fund, and explain exactly why you own this, but not that. So yes. Again, a good fee-only advisor should be able to explain those things to you in a way that you understand. And if they can't, I'd find somebody who could. So where do they pick up their education? Right? Where did they learn? So most people in the industry learn from the industry, which I would tell you is a mistake, because the industry educates their helpers in ways that make the industry a lot of money. So in other words, I'd want to hear that you've learned outside the industry. I'd want to learn that you've educated yourself from independent sources that provided a real education on these issues rather than something the industry wanted you to have. Oh, and that reminds me of a story. So this is a few years back. You and I brought in some financial advisor to provide an educational class during Financial Literacy Month. And I thought I'd sit in there to see exactly what this guy was going to say. And he does his spiel, and it was kind of disjointed, and it really wasn't all that helpful. But, you know, it was there. And at the end of the class, I said, so what books would you recommend any of us read to better understand these issues? And this financial advisor, who was an insurance agent, could not provide one book. Not one. He had never educated himself outside of his industry. Everything he knew was what the insurance company told him he had to know. That's telling. And it's not unusual. So they're driven by their ego. So that's the wrong fee-only advisor. Ego, right? I know the future of markets. I know the right stocks to own, and I can avoid the wrong. No, you can't, dude. Get that ego and get it out of here. You don't want somebody with a large ego running your investment portfolio. They're expensive. So if it was me, I wouldn't pay anybody more than 1% a year total. So for example, if you use somebody, whether it's an hourly or project-based or money under management, I'd make sure those fees are less than 1% a year. As you start to go above 1%, I'm talking about the advisor fee and then the investment fees, you start to get real numbers that are affecting your bottom line. So you want to keep those fees low even when it's a fee-only advisor. They're not educated well enough. So there are plenty of fee-only advisors out there who don't really know what they're doing. I mean, they may be trying, they may mean well, right? Let's say somebody is really trying to help you, but if you don't know what you're doing, maybe you're not the person for me. So this comes back to this idea that you're the one making this decision on who to hire and who not to hire. So you're asking these questions to make sure you get the right person. I don't like them. You don't trust them. Well, then get the hell out of there. I don't care if somebody was, Warren Buffett Jr. If I didn't like them, I wouldn't use them. I don't give a damn. Same with trust. If you can't trust them, don't use them. I don't care how good they are. It should not matter. So those two criteria all by themselves. If they don't pass the smell test on those two, then you don't need them. There's other people who can help you. So where do you go? Robo-advisors. Robo-advisors are online advisors. Wealthfront.com, Betterment.com. Robo-advisors. Basically, you're almost eliminating the human being in the equation. You're investing in low-cost ETFs at a very low cost. So robo-advisors certainly provide a service that can help some people. They've been created in many ways for millennials because supposedly millennials really don't want to talk to some human being. It's like, just do this stuff for me. It's good. I don't need to talk. Well, that's what robo-advisors do. And they'll put together a good low-cost portfolio that can serve your needs. In other words, there's nothing terribly wrong with robo-advisors. NAPFA.org. So that site, you can go on there, put in a zip code that you're at, and identify a financial planner in your area that's fee only. So if you're looking for somebody on a big scale, or if you have a relative, a loved one who lives in Washington State or Texas, they could put their zip code in to look for somebody who is fee only in their area. Now, saying that, just because they're fee only, it doesn't mean they should just pick them. They still need to go through the criteria and make sure they're the right fit for them. Vanguard, Fidelity, Schwab, they all provide advisory services. Now, Fidelity is way too high. I would not recommend Fidelity. I think Schwab's not too bad. Vanguard isn't bad. They charge 0.3 to manage your money. So then they're going to put you in index funds or ETFs, and it's going to be, about 0.5% per year in fees. So I wouldn't blame you if you chose Vanguard if you need an advisor. But again, the problem with a lot of this is human beings. If you want somebody to sit across the table from you, you're going to have to look elsewhere. And locally in Cedar Falls, Waterloo, another story. So I moved here 10 years ago, and I was trying to help somebody. They needed an advisor. I was trying to find a fee-only advisor for them. And I'm looking, I go to NAPFA. The closest one I found was Cedar Rapids. Not one in this entire Waterloo, Cedar Falls area. It was insane to me. It's insane that this area did not have one. Well, the good news, over the last 10 years, we've got them. And we have a couple here tonight, and they'll introduce themselves and talk about what they do, and you're welcome to ask any questions you like. But we now have fee-only advisors, and gradually this is becoming a bigger issue for those people who are informed on the issue. So I'll give Mike a chance to stand up and explain his services and what he offers. Mike Dunlop.
Hello, I am Mike Dunlop. Thanks, Mike. I am a fee-only advisor in Cedar Falls with Dunlop Financial. I am a fiduciary. That means I work only for you, and I only earn my commissions or my fees from you. I earn no money from anyone else. And I'm also independent. And what that means is I don't work for somebody else that needs to take a cut of money. I work only for myself. Those three things mean that I can help you independently in your unique situation. I do financial planning and I do investment management. You know, Mike talked about investment management. That is one small piece that's all around what your financial plan needs are. So I can help you with Medicare, with how to draw it, when to draw it, what kind of plan to get. Social Security, the same thing. If you got kids, we do college planning. If you got student loans that never go away, we look at how you can maybe work with your student loans. You know, taxes, everything, you know, related to taxes, we can kind of talk about. Everything financial planning. That's what I do. I don't want to take too much time, but what questions does anybody have? My charge runs from 0.8 down to 0.3%.
With regard to how much to draw from or the Medicare question.
What's that?
How's that?
So how does Medicare? So we'll look at what your goals and your plans are when you retire. And, you know, depending on what you're going to do and where you're going to go and how much money you're going to have, we're going to look at what's the right Medicare plan. You know, do we want to supplement? Do we want to Advantage? When do we draw that? You know, maybe you're still working and you need to draw. So there's all kinds of complexities related around that.
Mike?
And that all goes into the same fee. That's all covered.
Yeah, so like if somebody just wanted questions answered on Medicare and Social Security,
Oh, and not do, is that what you're asking? I'm sorry.
Yeah.
Oh, I'm sorry. We can do a project as well. So if you don't need investment management, if you just need a financial plan or maybe a couple hours, we can do that. I work at 150 an hour, and you know, if we do a complete financial plan for you, depending on how flexible, you know, might be around $2,000, $2,500 for a complete plan that would set you up for 5 or 10 years of you know, your financial.
and what makes Mike distinctive in this area, he manages money for people, right? So if somebody is not able to manage their money themselves, that's what he does. He will actually run it for you.
And that, looking at rebalancing, have you talked about rebalancing, I assume?
A little bit, but go right ahead.
Doing your RMDs when you get where you're 70 and a half, making sure you're getting up to date again. Aspects of money, you know, maybe you need to do a 401k rollover, an inherited IRA, just all of those complexities, I manage that for you, in that fee that I talked about. Other questions? I don't do the bills and trust, but we can kind of talk about them up front. I have a resource that I would send you to, that would help you with that prior to going to an attorney.
And luckily, attorneys are cheap.
But part of the financial planning checklist is making sure you have a will. And then if you do have one, I would go through it with you and make sure it's updated and make sure, you know, maybe you got divorced, but your ex-husband's still in the will or something. Those are the things you would look for, you know, or maybe you've got one kid you don't like so much and you want to take him out of the will. That's the best way to do that. There's all, you know, there's so many scenarios with that. So. Other questions? Where did I get my education? If you look that way, about 10 degrees, that's where I got a lot of it. I got a lot of it from reading books. I studied accounting at University of Northern Iowa. And I belong to NAPFA. I belong to a couple other organizations that are the organizations that provide education as well. So, but I started off on the right foot. Yeah. So, good.
How do you determine that your fees are 0.8?
So there's kind of a tiered level. So from anything from 0 to 500,000 is going to be at 0.8. Anything from 500,000 to $1 million is going to be at 0.6. $1 million to $1.5 million, 0.5, and then anything you have is over $1.5 million, on up to 100 million, 0.3.
And what I would tell you is, on the scale outside of that, that's low.
That's very low.
So when you're looking at managing people's money, that's about as low as you're generally going to get from a human being helping you with your finances.
And I manage places. I either manage Vanguard, or I also manage at TD Ameritrade. And that's something that each situation is unique, and we would talk about that. That's the two places that I manage.
What kind of investments do you normally put them in, Mike?
Everything that I do is typically a passive portfolio like we talked about. I've done index funds at Vanguard, what I've traditionally done, the low cost ones. All of my clients' portfolios are right around 1.1% or less. I just started with TD Ameritrade. Those are going to be in ETFs probably, just simply because TD doesn't offer as many low-cost index funds that other ETFs are in that realm. Plus, down the road, I don't know if you talked about BFA at all.
I have not.
Okay. BFA is a company that they took the research of online friends. I don't know if we talked about them in here or not.
A little bit.
And they've incorporated into their funds. They're a little higher performing funds, but they're a little higher cost. But that cost is usually justified by the outperformance of it. So I'm going to be doing that here shortly as well. So I don't know, any other questions? Good questions.
Okay.
There are some cards up here, or I'll be here afterwards if anybody's interested in talking to me. I'd love to hear from you. Thank you.
Thank you, Mike. Casey Redmond is not able to be here tonight. I'd like to give you a brief explanation of how he works as a fee-only advisor. So he does not manage people's money for them. He basically will set you up with a financial plan, or he will come in and look at your portfolio, identify the cost, and charge you based on how much he's going to save you in 1 year on cost, up to a certain amount. So he's basically going to save you on fees, and then put your portfolio together, and then you do it yourself for the rest of your life. So you can also have his assistance by the month, if you choose to do that, where you pay a certain amount per month for his help, or you pay him an hourly fee on occasion. But Casey is somebody who is really passionate about this, and he can sit down with you and walk you through the process to get yourself in order. But again, his job is to try to help you do it yourself. Once it's there and done, you're on your own. And then maybe you would contact him later if you had any help, if you need any help. Okay, any questions on Casey? His card's up here too. And by the way, I'm sure you get this. There's no way in hell I'd bring anybody in here that I didn't trust, that I didn't think would serve your needs well. Next up, Patty Rasa.
Anyway, I'm Patty Ross. I'm with Annuity Financial Coaching, and I'm licensed to give financial advice in the state of Iowa. In order to do that, you have to pass the Series 65 test, so I've done that. Other licenses you can hold are the Series 7 and 63. I chose not to get that because my investment philosophy mirrors my with index fund investing and my education system. And other books and great investors of our time, really fortunate to have Mike in the area and educating us. The people that I've helped to date have sat in these chairs just like you guys, because they have the core knowledge. So you're not trying to convince them of something, which is pretty hard to do when you see all the commercials with Wall Street, Northwestern Mutual, etc. So basically, when I help people, when I help people, we just have a one-on-one conversation initially. The first week is free, just to see where you're at, what you need. Everybody's story is totally different. You know, some people are young, some people are older, some people are still working, some people are going to retirement. So it's different for everybody. And so just kind of meet where you're at. My goal when I'm done with people, and it's usually a 4 or 5 step process, is that they feel comfortable with what their investments are, that they know their expense ratio, okay, and that they know how to do the admin part of it. A lot of people get their statements, put it to the side, and then really that's it. A lot of them don't even have online. So it's kind of like a new toy when you get into Vanguard or Fidelity or whatever you do, to look and see what's going on with it and gain that knowledge. And then, of course, I'm hoping that they spread the word and help their people in their lives too. So my charge is first maybe free, $50 an hour. From there, like you said, the goal is that you're independent when you part ways, and that you feel comfortable managing your money portfolio, and and you know how to grow it, you come back to my spot. Any questions?
Just a flat $50 an hour, not a percentage.
Correct. Yeah, I don't manage, assets. So, I'm not managing assets. So it's just, you're gonna take over the reins here when we're done.
So in case you're wondering, that's as cheap as it gets, right? Patty's goal is to help people. Her goal is not to get rich through this process. And so the average, Mike's charge of $150 an hour is far below the average. Again, there are people who charge $500 to $1,000 an hour. So I would tell you these fees are reasonable if you need help.
Yeah, yeah. How many hours is that? You know, he's really not that, yeah, it's just paperwork time, transfer from one place to the other, or, you know, electronic world, you know, and understanding what you're doing. And then also, right, I help you take care of that. Yep, work together, yep. All right.
Well, and keep in mind, she's helping you do it yourself, and she's helping you make sure that this thing you're doing is working with everything else within the rest of your life.
And I have a question, I know that. So, thanks, guys.
Thank you, Patty. Well, Axel is one of the newest members of the fee-only community here locally. He works for John Deere. So he's an engineer out there, and he tends to work primarily with John Deere people. So if you have any interest, you work at John Deere, he knows that 401k well, the pension system well. He knows a lot about the life of John Deere employees. So certainly consider his services if needed. Any questions on fee-only advisors before we move on? This is the opportunity, folks, right? Nobody's here to sell you anything. Resources. So my book, my second book, What Colors the Sky, is a book on investing. I talk about these issues as well as asset allocation, putting all this stuff together into a life where you're actually in charge of your money. Investment Answer is written by a couple of financial advisors. They show you why you should avoid fee-based advisors. They walk you through the process, and it's a pretty simple book. Look at that. Okay? And the point here is, it's not that hard. You learn the basics, you realize what not to do, and you just do the things that you should do. That 12-step recovery, you know, I'm sure some of you, yeah, it's kind of like the alcoholic. You have to train you have to go through the process of learning about index funds, which many of you have already done, and rethinking, retraining yourself on what you think is the right thing to do. I had to go through that. Many people have to go through that, especially when our initial education was from the financial industry. So good book, full of illustrations, pretty easy book to read. And then The 4 Pillars of Investing by Bernstein. You've heard me talk about that before. It's awesome. Best investment book I've ever read. Saying that, it is not for beginners, okay? It is a challenging book. It's a book that I would recommend you read after you've read some of the other books. But I would tell you it is awesome. Anything Bernstein writes, you should read. It's great information. It helps you see this whole picture in a more clear light. So some final thoughts. System's built for the system. Just accept that, acknowledge it. It's sure not built for us. Just understand how it works. Understand how people make their money. Once you do that, figure out ways so they make less of your money. This is something that comes up fairly often. You know, oh, he's such a nice young man. I know, okay? I'm not here to say these people are evil. They can be nice. They can go to your church with you. They can go have a ball game with their kids because they have kids. I'm not saying they're bad people. I'm saying the products and the services they provide are not what you should own. Mike?
A lot of time when I see somebody move their money, the most common reason for not moving the money is my advisor's nice. That's what I'm saying.
I know.
You want your money or your advisor?
Yeah. So the way I lay that out, you can give the money to your advisor or to you and your heirs. Talking about your kids and grandkids. I mean, and if you want to give your money to the advisor instead of your kids, well, then that's up to you. But that's what's happening. When you select a fee-based advisor, your money's gradually being siphoned off for them. Bottom line, build your investment accounts to his. You want to build yours so they're going to grow over time. And you can do that. In today's world, thanks to John Bogle, you have the ability to invest just as well as the wealthiest people in America. Again, I've said this once maybe. This is one of the few things that we have in America. You and I have just as good of an opportunity to invest our money as the wealthiest people living today. That is never the case, almost, ever. The wealthy tend to have a lot more opportunities, a lot more advantages than people like you and me. Not in this game. Thanks to Bogle, thanks to those low-cost index funds, you and I get to invest as good as anybody else. There is no advantage other than your education. If you need help, select a fee-only advisor, right? Nothing wrong with that. If you need help, or if you have a loved one who needs help, right? They mentioned it. Every single one of these people will sit down with you at no cost. If you want to have a consultation, you're trying to figure out if they're the right fit. They're trying to figure out if you're the right fit. Sit down and discuss it. And if you agree on a price and what you're going to do, you move on. If you don't, you go your opposite ways, and that's okay. Just make sure you pick the right advisor, right? Because at the end of the day, it's your call. Your call. The advisor that you have or going to have will be your decision. Understand that a financial plan is important. A financial plan puts you in a position to where you have a clear path to a future of financial freedom. At the end of the day, if you do the right things based off a good education from independent sources, you will see your portfolio higher over time, with ups and downs as markets go. Now, sometimes people will call me and say, Finley, the market's down. Okay, you want me to call the market? What do you want me to do, right? There's nothing to do in those cases, but when you squeeze out fees, and this is incredibly important, when you squeeze out the fees of a portfolio, the downs are not as low, and the highs are higher. And when you put that into play for years and decades, those small increments become huge dollar amounts. Huge. And that's the key. That's what we're trying to accomplish here. So your money is growing at the best possible rate over time based on how markets do with your portfolio. U.S. markets, stocks, bonds, international markets, and stocks. Questions? Questions on this whole issue of financial advisors? Yes, sir.
This isn't so pertinent tonight, but could you please differentiate between index ETFs and the index funds that we should be in?
You bet. So the difference between a low-cost ETF and a low-cost index fund is almost nothing. In other words, the fees are about the same. I don't like ETFs, neither did John Bogle, not because ETFs are bad, but because people trade them like individual stocks. You can trade an ETF, exchange-traded fund, in real time in the market. And Wall Street loves them. So right off the bat, anything Wall Street loves, we should be worried about. Because if Wall Street loves it, there's a lot of money in it. So an ETF, if you buy it and you hold it like you would an index fund, there's nothing wrong. So for instance, you can own the Spider ETF, which is a 500 index. Same thing, you buy and you hold, you'll be just as good with that as you would with the 500 index. Just as good, no problem whatsoever. Again, it's how people actually use the ETFs, that's the problem. So, say it again. I'm talking about broad market index funds, you bet. And again, so be clear, nothing wrong with them, but use them in the way you would use an index fund. You buy and you hold. So people just don't seem to do that. They don't want to do that. Otherwise, fees can be very similar. Was there any other part to that, sir? As far as the kind of index funds at Vanguard, it's real simple. Vanguard Total Stock Market Index Fund. You can go to my website under Investments and Recommended Investments on the menu. You know, the Total Stock Market Index Fund owns the entire U.S. economy. Total International Stock Index, international stock, all outside the U.S. Total Bond, all high-quality bonds. It's not that hard. People try to make this issue hard because, well, because there's a lot of money in it. Less is more. Keep it simple. Other questions? Okay, so my story tonight is a real life story, and it's a sad story, but I think it's worth telling. So a few years back, I had a family member who passed away. He had an $800,000 term policy to provide for his family. And he passed from brain cancer. Took about 7 months, he was gone. And so the life insurance agent shows up with that $800,000 check. And what do you think that agent wanted to do? He wanted to have his wife put that into an annuity, paying that 8% commission. $64,000 could have been gone like that. Luckily, her and I had a conversation. She knew to take that check, put it in the bank, tell the agent to go away, and then she invested those funds in low-cost index funds that fit her situation going forward. It would have been very easy for her to have fallen for that, right? She was distraught, she was hurt, and that agent was ready to take advantage of that. Don't let that happen to you and your loved ones. Thank you, folks.
Asset allocation according to your personality. So you want one, you're up at the